Hello and welcome to another weekly trade recap where we aim to make $1,000 per week using S&P 500 weekly options and futures. Last week we made $1,500 on June 7th, and you can learn more about that trade by clicking right here. We also exited the silver, one of the contracts for this amount, and are still holding on to the majority of our GDXJ calls. This week we're currently holding an SPY bull credit spread, where we're short the 204 strike. So the 204 strike roughly coincides with the 2040 level in the E-mini future. And just to look at the charts here, 2040 is around here. So we're basically betting that the market will stay above 2040 by next expiration Friday. The theme of today's video is avoiding pitfalls of trading Fed days into fourth wave support. So I have to admit that this past week was really volatile and it was not easy to enter. We actually got a few fake outs that left us stopped out of our position and we had to re-enter. One thing I'll point out is this right here, this spike up was the Fed announcement. So the pitfall with these Fed announcements is that the market can be really volatile. It can fake out in one direction and reverse the other way. And so before this Fed announcement, I actually made a prediction. So I made a prediction here where we had this support from this extension, and prior support would now act as resistance now that we broke down. And I was expecting a retest into this 25-26 region, and from there, if the Fed announcement is such that it pushes it this way, it could sell off. And so that's actually the mentality I had coming in here. The trading issue, though, was once we got up to this area at the Fed announcement, we spiked up further, and that gave me the impression, well, maybe we won't turn back down. Instead, we might just rock it up. And that's where that booby trap was that I fell into. So here's a chart of what actually happened. So basically we ran up to that 25-26 level as I expected. Prior support is now resistance, and this spike up faked me out. And so we tried to enter in a bullish position, and we held actually for a good hour, an hour and a half. But then right towards the end, before the close, the market just sold off. And so I had said that I would hold on unless we go straight down, and the thing is we did go straight down, and I was stopped out, exited in the mid 2060s, and had to wait till the next day. So even though we had a bullish option spread and we were stopped out, the following day right here in this 2058 region, we were able to re-enter that option trade, and that's what you saw before. That's what this trade is here, the bull put spread. Now the reason why I entered a bullish put spread here was so we entered the bullish option trade here. The reason is because we got a 5-wave pattern in what is potentially the 5th wave position. So you can view this as A, B, 1, 2, 3, 4, 5. Or somehow if you saw this as 1, 2, 3, 4, 5, and then this is like a B wave, if you had an A, B, C, right? But the thing is we reversed back up, so that A, B, C is now no longer one of the options. So we have a 4th wave support, and in the 5th wave position we have 1, 2, 3, 4, 5, and then a quick reversal. So that alone was enough to say that we would execute a bull put spread. Now it continued to rocket up and it turned back down the next day. The purpose of this weekly option spread trade is to hold it into expiration. So yeah, sure, if you bought futures, you would have been up a lot here, and then the next day you would have been down a lot, but basically back into break even. But the thing about the put option, the put credit spread, the fluctuation of your account won't be as drastic as it is with futures. So the only thing you're betting with in the put option spread trade is to say that the SPY will stay above 204. So we're basically saying it's going to stay above this 2040 region, maybe it's 2035-ish. And as long as this A, B, and then you get a 1, 2, 3, 4, 5 pattern holds out, even if it's not exactly that, if it's A, B, and it just, as long as it holds below, above this low by next Friday, then this trade will give us maximum profit of somewhere around $1,200 to $1,500. But the key is not to get below this 2050, 2045 range, and definitely not below 2040. So the pitfall with trading these Fed decisions is you gotta watch out for these spikes, because whenever you have this kind of resistance zone, that zone is usually like several points wide. So it could be anywhere from 2074 to 75, 76, 77, 78. This thing went all the way to 79 and then it reversed. So the key is whenever there's a reversal here, you gotta have stops in place. And at first we did have stops in place, but then it reversed back up and consolidated. And that consolidation made me think, well, maybe it has a chance to reverse. But then it turned back down, and then once it broke this 2068 level, then you should be getting out. Even when you get out, that doesn't mean that the market's not gonna continue in the direction that you want. It could be that you just get a better price, and in this case, we could get that better price at 2058. Now remember, we got a net credit of 109. This is a lot higher than usual, right? So you got to fill at 1.09. Usually we get fills for the amount of distance that we trade away from where the market is. You get closer to 70 cents or 80 cents. And why is it that we got 109? Well, the reason is because volatility has been elevated. So if you look at volatility, if you go to the futures and you look at volatility, you'll notice that it's been elevated, right? So for the past couple of weeks, we've been like in the 15, even 14 region, but now we're all the way up above 20. So with elevated VIX volatility, then the value of options also increases. And so that partially explains why this option we were able to get $1.09 when typically we would get something closer to 70 cents or 75 cents. So right now we're in the weekend. We should be getting some weekend time decay, and as long as the market follows the pattern of A, B, 1, 2, 3, 4, 5, then we should stay above this kind of break-even line. So we entered this trade around 20, let's say around this area. You can imagine a slightly declining slope line of where the break-even point is. So we have this is one day, you have another 5 days until the next Friday. So you can imagine that imaginary line as the break-even point. Eventually this line intersects with where SPY 204 is, which is roughly in this kind of region right here. So one interesting thing to note is that with volatility during this Friday was still subdued. It did not spike back up even as the market dropped a little bit. So the market dropped from here all the way here, but if you look at VIX, the VIX did not jump back up to 21. It actually stayed below 20.5. So when the VIX, that's the fear index. So the fact that we fell even as volatility did not pop, right? So volatility just kind of stayed flat. The fact that we fell and that happened at the same time bodes well for this particular account. At least it increases the probability a little bit more. And the probability that this is a kind of a 1-2-1-2 setup down is a little bit less because of this massive jump up. So if we zoom in into this B wave drop, just to get a sense of what the microstructure is, you basically get this chart right here, right? So this drop right here is basically this drop right here. So if you look at it carefully, it's basically what looks like an AB and then C pattern. So an ABC within that B wave drop. And then what follows next is basically another A wave up, another B wave down. And each A wave consists of A, B, 1, 2, 3, and then in the other direction, A, B, 1, 2, 3, right? So this looks like it could be an AB. As long as this bottom that happened after 4 p.m., as long as that bottom holds, it could be that it just coils up and moves in that direction. If, however, it kind of aggressively goes below this region, then you got to reconsider. Maybe even this B wave has like an A, B, C, and it goes down towards you know lower 2050s. It's possible, or even 2048. But if it goes into that area, then we'll have to reconsider our position potentially. And just a quick update on silver. Silver, I posted this chart the other day. There was a big drop here, and I noted this potential 1, 2, 3, fourth rise, and then a fifth wave blow up, and then with the wave 2 correction. And it could be that wave 2 is A, B, C, or it could be that that's all of wave 2 and then we start coiling up. So if you compare this chart with what silver is now, we go here, we go to metals, and we click silver. You go to the hourly chart. So basically we have that 1, 2, 3, 4, 5, and then wave 2 down. So it could be that this is a B wave up and we have another drop to 17, maybe even slightly below that. Or it could be that that's all of wave 2 and we start coiling up, potentially breaking out. So those are two possibilities with silver. Either way, I'm going to hold silver for now. Remember, we entered our position. We entered at 16.03. We also entered again at 16.43. We sold at 17.29, somewhere in this region. And so we're just holding on to that last contract and see where it takes us. But the plan is to hold on to the silver and to hold on to the GDXJ July 15 44 strike calls, and those are the gold miners, and we'll hold that until we see an opportunity to sell. Lastly, I did want to let you know about the Ultimate Stock Market Wave Surfing video course. It's now available for pre-sale. If you use the coupon code presale100, you'll get $100 off. This course is not completely ready yet, but if you place your order now, you'll get a discount. And basically every day I've been documenting charts and graphs of every type of wave pattern that you could possibly see, and I categorize them. So you'll see certain patterns repeat, like certain patterns we're seeing now are the same patterns we saw a few months ago. And what I did was I put them all together, walk through the different wave diagrams and patterns, and so a lot of them not only appear throughout 2016 but also throughout stock market history. So if you look at this link, this course details page, you'll see a lot of these kind of patterns that I draw out. And yeah, this is the stock market crash of 1987. We actually ran up right before 1987 and then crashed. And then of course what followed was the third wave, and the third wave is the strongest wave. That was the kind of the internet boom of the 90s all the way to 2000, and then from there we had a fourth wave correction. And part of that fourth wave correction was an ABC. That C wave is the strongest. That was the 2007 to 2009 financial crisis. And what happens after the C wave? Well, you get a massive fifth wave up, and that's what happened for the past 7 years, until, well, of course, you have this January 2016 stock market correction, an A, B, C, and corrective wave 2 flat with the third wave massive down. So just to see what that looks like, if you've been trading in 2016, you're familiar with what the S&P 500 looked like on a daily chart. So this is that A, B, C wave 2 flat followed by the massive wave 3 down. Now, if you look at the NASDAQ, there could be, right now, this is the S&P, but if you look at the NASDAQ, there could be an A, B, and if you get a C to like 4440, I'll zoom in here. This is an A, B, if you get a C to 4440-ish, somewhere around here, and then it turns back down and breaks 4350, that would be a huge indication that a massive wave 3 down would happen. But judging from the daily chart, the size of this kind of potential versus this is, this one was way bigger. But even so, it's good to be aware of these kind of wave patterns so that you can spot them ahead of time before these kind of massive moves happen. And that's actually what we cover, part of what we cover in this stock market wave surfing class. And so these are principles that you can apply in gold, silver, any globally traded, highly liquid, mass volume markets. And so these are the markets that these kind of principles work well with. They follow human psychology. Um, and this is kind of like a sense of what you'll see, some foundations of Elliott wave theory, specific patterns. I talked about a few just before, but there's way more, and I'm adding more and more to these, to these categories in course modules every single day. You won't find this kind of practical real life education anywhere else, and really the opportunity is right in front of you. If right now I'm still creating the course and adding content and creating the videos, but if you pre-order now, you get $100 off of the $5.99 list price. It'll be $4.99 when you use the coupon code presale100. A lot of you have already started to sign up, and that's great. For the rest of you, take a look. This is some really great, incredible stuff. And when it comes to training, I cannot stress the importance of understanding the past so that you can better serve and better trade the future. A few weeks ago, I sent out a survey for some of you guys on WhatsApp on whether you prefer auto trading versus course material, and it was basically half and half. It's amazing. But basically, I'm in the process of looking into auto trading as well. I've actually partnered with a third-party company called Global Auto Trading that will allow you to auto trade my alerts directly into your brokerage account, so you won't miss any trades. I still have to get familiar with how exactly that works, but that's something in the works. That's it for now. Signing off, this is Silver Surfer, and best of luck to your trading, and may the waves be with you.